You've been told that a 3-to-1 risk-reward ratio is the holy grail of trading. Risk 100 to make 300, win just 25% of the time, and you'll be profitable. The math checks out perfectly. Except there's one problem. Professional trading firms don't actually use this approach, and if you look at the data, it's destroying retail traders at an alarming rate. Here's what nobody tells you. A study from the University of California found that traders who experienced 5 or more consecutive losses performed 23% worse on their next trades, not because their strategy changed, but because their psychology collapsed. And with a 35% win rate system, those brutal losing streaks aren't rare events. They're statistical certainties happening multiple times per year. Meanwhile, firms like Jane Street and SMB Capital, some of the most successful prop trading operations in the world, are quietly using 1-to-1 risk-reward systems with higher win rates. In the next few minutes, I'm going to show you exactly why the 1-to-1 approach with a 55% win rate will outperform the 3-to-1 system for most traders, even when the expected value is identical on paper. We'll break down the neuroscience, the math of losing streaks, and what actually happens to your brain and your account when you trade these systems in real market conditions. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let me ask you a question. Can you handle losing 8 trades in a row? Not once in your career. Multiple times per year. Because if you're running a 3-to-1 risk-reward system with a 35% win rate, that's not a worst-case scenario. That's normal Tuesday operation. And this is where the entire conversation about risk-reward ratios falls apart. Everyone focuses on the pretty math. Risk 100 to make 300, win 25% of the time, break even. Win 35% of the time, you're profitable. But nobody talks about what that 35% win rate actually means in practice. It means you're losing 65% of your trades, almost 7 out of every 10. And those losses don't distribute themselves evenly across your trading career like some textbook probability distribution. They cluster, they stack, they create psychological warfare that no amount of journal entries or meditation apps can fully neutralize. Let me show you what this looks like in reality. Meet 2 traders. We'll call them Alex and Jordan. Alex is trading a 1-to-1 system, risking 100 to make 100, with a 55% win rate. Jordan is trading the recommended 3-to-1 system, risking 100 to make 300, with a 35% win rate. On paper, in a spreadsheet, both can be profitable. But let's run the actual probability of hitting consecutive losing streaks. For Jordan, with that 35% win rate, the probability of hitting 5 losses in a row is about 12%. That's roughly once every 8 trading stretches. 8 losses in a row? About 2%. Doesn't sound too bad until you realize that if you're taking 200 trades a year, you're likely to experience that nightmare at least twice. And here's the thing, when you're in loss number 7, staring at your screen, watching another position get stopped out, your brain doesn't care about probability distributions. Your brain cares that you've been wrong 7 times in a row, and everything in your biology is screaming that something is catastrophically broken. For Alex, with a 55% win rate, 5 losses in a row has only a 2% probability. 8 losses in a row is so statistically rare, it might happen once every few years, if at all. The psychological difference between those 2 experiences isn't just noticeable. It's the difference between a trader who stays in the game and a trader who blows up their account trying to fix a system that isn't actually broken. But let's go deeper, because what's happening in your skull during these losing streaks is far more destructive than most traders realize. Researchers at MIT studied what happens to traders' bodies during consecutive losses, and what they found should terrify anyone advocating for low win rate systems. When traders experienced repeated losses, their physiological response was identical to preparing for physical combat. Heart rate spiking, adrenaline flooding, cortisol levels elevating. And here's what matters, it wasn't the size of the loss that created the stress response. It was the frequency and unpredictability. They compared 2 groups. One group lost $1,000 regularly, but with some wins mixed in. Another group would occasionally win $3,000, but lost $1,000 repeatedly in clusters. The second group, even though they were mathematically making money, showed severe stress markers. Their bodies were treating the trading environment as a threat. Now think about what this means for Jordan. With his 3-to-1 system, he's living in that second group. He might hit a massive $3,000 win, but he knows statistically that it's probably followed by multiple losses. His body never gets to relax. His cortisol stays elevated. His nervous system stays in threat mode. There's a concept in neuroscience called reward prediction error. Your brain releases dopamine, not when you receive a reward, but when you receive a reward that exceeds your prediction. This is the entire mechanism behind why slot machines are addictive. The unpredictability creates these massive dopamine spikes. But here's the catch, when you're constantly predicting a win because that's what you're trying to do as a trader, and you're constantly wrong because you're only winning 35% of the time, You create what neuroscientists call a dopamine drought. Your brain is repeatedly making predictions that don't materialize. This isn't just about feeling bad. The research shows that repeated negative prediction errors physically decrease activity in your prefrontal cortex, the part of your brain responsible for rational decision-making, while simultaneously increasing activity in your amygdala, your fear center. In plain terms, losing repeatedly doesn't just hurt your feelings. It makes you dumber and more scared. You're literally operating with reduced cognitive capacity. Now think about making trading decisions in that state. You're not the same trader you were at the beginning of the streak. Your pattern recognition is impaired. Your risk assessment is compromised. Your discipline is hanging by a thread. Alex, trading that one-to-one system with a 55% win rate, operates in a completely different neurological environment. She's winning more than she's losing. Her brain gets regular dopamine hits. Her prefrontal cortex stays active and engaged. Her amygdala stays quiet. She can think clearly. She can execute her plan. She's not fighting her own biology every single day. And then there's the winner's effect. This is one of the most powerful phenomena in trading psychology, and almost nobody talks about it. Scientists studying everything from animals to Wall Street traders discovered that winning creates a biochemical feedback loop. When you win, your testosterone levels spike. That elevated testosterone doesn't just make you feel confident, it actually improves your cognitive performance. Your pattern recognition gets sharper. Your risk assessment becomes more accurate. Your execution speed improves. You make better trades because you won earlier. It's a virtuous cycle. John Coates, a former Wall Street trader who became a neuroscience researcher, measured hormone levels in traders throughout the day. What he found was remarkable. Traders who had winning mornings had significantly elevated testosterone in the afternoon, and this hormonal state made them better traders. They weren't just feeling good. They were operating with enhanced cognitive abilities. Conversely, traders on losing streaks had elevated cortisol, which impaired their function across the board. Here's why this destroys the argument for 3-to-1 systems. The winner's effect requires winning frequently enough to maintain it. Alex wins 55% of the time. She might lose 2 trades, but then she wins 2 or 3. Her testosterone stays elevated. Her confidence remains stable. Her decision-making stays sharp. She's operating inside a virtuous cycle, where winning makes her more likely to win again. Jordan, winning only 35% of his trades, spends most of his time in a cortisol-elevated, confidence-depleted state. Even when he catches that big 3-to-1 winner, he knows statistically that multiple losses are probably around the corner. He can't maintain the winner's effect because wins are too infrequent. He's stuck in a vicious cycle where losing makes him more likely to lose again, not because his strategy is wrong, but because his biology is working against him. Now let's talk about what all of this looks like on an actual equity curve, because this is where theory meets the brutal reality of execution. Alex's 1-to-1 system produces an equity curve that looks like a staircase. Up a step, down a step, up 2 steps, down a step, up a step. It's not smooth. Trading never is. But it's steady. The upward trend is visible. The setbacks are modest. She can look at her chart and see progress. She can trust the process, because the process looks like it's working most of the time. Jordan's 3-to-1 system produces an equity curve that looks like a roller coaster designed by someone who hates humans. Long, stomach-churning drops interrupted by occasional massive vertical spikes. The overall trend might be upward if he can survive long enough, but you'd need the emotional discipline of a Buddhist monk who's been meditating in a cave for 20 years. With Alex's curve, you wake up most mornings feeling stable. You're not getting rich overnight, but you're not bleeding either. You can see clear progress. You can trust that what you're doing is working. With Jordan's curve, you wake up most mornings feeling anxious. You're either down significantly from your peak, wondering if you've lost your edge, or you're up significantly but knowing that a drawdown is probably coming. You can't trust the process, because the process feels broken most of the time, even when it mathematically isn't. There's actually a metric for this called the ulcer index, and yes, it's literally named after stress-induced ulcers that volatile equity curves can cause. In backtests comparing systems with identical expected values but different win rates, the lower win rate systems consistently produced ulcer index scores 2 to 3 times higher. This matters because trading isn't just about having a mathematical edge. It's about whether you can execute that edge. And you can't execute if you're psychologically destroyed by the natural variance of your own system. Jordan might abandon his 3-to-1 strategy right before it hits that big winning streak. He's been losing for weeks. He's down 15%. His cortisol is through the roof. His confidence is shattered. He decides the system must be broken and stops trading it. Then the market trends, and his system would have caught multiple massive winners that would have made his entire year. But he's not there to catch them, because the psychological pain became unbearable. Alex never faces this temptation because her equity curve never gets painful enough to trigger abandonment. She stays in the game, and in trading, staying in the game is 80% of winning. Let me show you where this difference becomes absolutely critical. Prop firm challenges. Most firms have similar structures. They give you a $100,000 demo account. You cannot exceed a 10% drawdown at any point. Hit that limit, and it's game over. No second chances. You're buying another challenge. Let's run the math on how Alex and Jordan perform in this environment. Jordan, trading his 3-to-1 system, risks 1% per trade. That's $1,000. He takes about 30 trades over the 30-day challenge period. With his 35% win rate, he'll win roughly 10 trades and lose 20. But those wins and losses won't distribute evenly. Remember our losing streak analysis? There's a very real probability Jordan hits 8 or 10 losses in a row during this challenge. Just 8 consecutive losses puts him at negative $8,000. That's an 8% drawdown. He's now terrifyingly close to blowing the challenge, with almost no room for error. And remember, this isn't him doing anything wrong. This is the system operating exactly as designed. But the prop firm challenge doesn't care about long-term expected value. It cares about what happens during these specific 30 days. Alex, trading her 1-to-1 system with a 55% win rate, also risks $1,000 per trade. Over 30 trades, she'll win roughly 16 and lose 14. Her worst-case losing streak is probably 4 or 5 trades maximum. That's a $4,000 to $5,000 drawdown. Uncomfortable, sure, but she's nowhere near the 10% limit. She has breathing room. She can keep trading without fear. She can execute her plan. Monte Carlo simulations, where you run thousands of iterations of these scenarios, show something striking. The 1-to-1 system with a 55% win rate passes 67% of prop firm challenges. The 3-to-1 system with a 35% win rate passes only 41%. If you're Jordan, you'll probably need to buy 2 or 3 challenges before you pass one. That's over $1,000 in sunk costs before you even start trading a funded account. With Alex's approach, you'll probably pass on your first or second attempt. And here's something that should tell you everything. Prop firms, in their internal training programs for their own traders, don't actually teach 3-to-1 risk-reward obsession. They teach whatever gives their traders the highest probability of consistent, low-volatility returns. Because they know that traders who blow up psychologically don't make the firm money. They know the math doesn't work if the human can't execute it. But there's another advantage to the 1-to-1 approach that nobody talks about. Trade frequency and learning velocity. Jordan is hunting for 3-to-1 setups. These don't appear often. The market needs to offer you 3 times the distance to a target as you're risking to a stop loss. This requires very specific conditions. Strong directional moves with tight consolidations you can hide your stop behind. In a typical month, Jordan might find 8 to 12 high-quality 3-to-1 setups if he's patient and selective. Alex is looking for 1-to-1 setups. These are everywhere. Any decent support or resistance level. Any breakout with momentum. Any pullback in a trend. She's finding 20 to 30 solid setups per month without compromising quality. Now you might think, aren't more trades just more opportunities to lose? Only if you don't have an edge. If you have a genuine edge, more trades means more opportunities to express that edge. But here's what really matters. Every trade is a data point. Every trade teaches you something about your strategy, about current market conditions, about your own psychology under pressure. Alex is gathering 20 to 30 data points per month. After 6 months, she has between 120 and 180 trades in her sample. That's enough data to actually know if her system works. She can calculate her real win rate, not her hoped-for win rate. She can see her maximum drawdown in actual market conditions. She can identify which setups work best, in which environments. She can distinguish between skill and luck. Jordan is gathering 8 to 12 data points per month. After 6 months, he has maybe 50 to 70 trades. That's barely enough to know anything with statistical confidence. He doesn't really know if his system works, or if he just got lucky or unlucky during this particular 6-month stretch. He's flying blind, making decisions based on inadequate information, and he won't even realize it until months more have passed. There's also market adaptability. Markets change. Sometimes they trend, sometimes they chop. Sometimes volatility expands, sometimes it dies. Alex, taking enough trades to see these changes quickly, can adapt. She notices when her win rate drops from 55% to 48% and can investigate why. Maybe her system needs tweaking for current conditions. Maybe certain setups aren't working right now. She has enough data flowing in to make informed decisions. Jordan takes so few trades that he won't even notice market regime changes until months have passed. By the time he has enough data to realize something's different, the market might have changed again. He's always adapting to yesterday's conditions because his sample size is too small to detect change in real time. Now here's what should make you question everything you've been taught. Go look at what actual professional trading firms do. Not YouTube educators. Not course sellers. Actual elite prop firms that make billions of dollars. Firms like Jane Street, one of the most successful trading operations in the world. You know what their risk-reward ratio is on most trades? About 1 to 1. They're not trying to hit home runs. They're trying to make small, consistent profits on massive volume. DRW Trading, another elite firm, uses strategies with high win rates and relatively tight risk-reward ratios. They scale position size. They manage risk dynamically. They focus on execution quality. The 3-to-1 risk-reward obsession is almost exclusively a retail trader phenomenon. And you know why it persists? Because it sounds smart. Because it's simple to teach. Because it makes compelling YouTube content. Just risk 100 to make 300. You only need to be right 25% of the time. It's a beautiful story. The problem is that beautiful stories and effective trading strategies are not the same thing. Professional traders think in terms of edge and execution, not in terms of fixed risk-reward ratios. They ask, what's the highest probability setup I can find right now? What's my edge in this specific market condition? How can I manage this position dynamically to maximize expected value? Fixed risk-reward thinking is rigid. Markets are fluid. You need fluid strategies to survive. Now, before we go further, I need to be clear about something, because context matters here, and nuance gets lost in trading discussions. I'm not saying 3-to-1 risk-reward ratios are universally wrong. I'm not telling you to never take a wide risk-reward trade. What I'm saying is that the dogmatic, context-free advice to always aim for 3-to-1 or better is setting most traders up for failure. There are absolutely situations where wider risk-reward ratios not only make sense, but are actually optimal. Let me show you exactly when and why. If you're position trading on higher timeframes, daily or weekly charts, the game changes completely. You're not taking 30 trades a month. You're taking 3 or 4 trades a quarter. You have very clear major technical levels that justify wide targets. A breakout of a consolidation pattern that's been building for months might genuinely offer 3-to-1 or even 5-to-1 potential with a reasonable stop placement. In that context, take it. Your sample size expectations are different. Your psychological tolerance is calibrated for longer holds and fewer trades. The entire risk model shifts. If you're trading in strongly trending markets, trailing your winners and letting them run makes total sense. You might enter a position targeting 1-to-1, but the trend extends and you end up with 3-to-1 or better because you managed it properly. That's not the same as forcing yourself to only take setups that offer 3-to-1 from entry. That's good trade management, responding to what the market is actually doing. There's a massive difference between rigidly hunting for 3-to-1 setups and dynamically achieving 3-to-1 through proper position management. And here's the critical part. If you have a specific setup that you've backtested thoroughly, and it legitimately produces profitable results with wide risk-reward ratios, then trade it. But, and this is crucial, thoroughly means hundreds of trades across multiple market conditions. You need to know your real win rate, not your hoped-for win rate. You need to know your real maximum drawdown. You need to know your real psychological tolerance for the losing streaks that will inevitably come. You need to have lived through those 8 consecutive losses in your backtest and confirm that you can emotionally handle it when it happens in live trading. Some traders genuinely have the psychological makeup to handle low win rates. They don't get fazed by losing streaks. They trust their system completely, even during brutal drawdowns. They have sufficient capital to weather large equity swings without it affecting their life. For these traders, and they are rare, wider risk-reward ratios might actually be optimal. But most traders, especially newer traders, traders with smaller accounts, traders doing prop firm challenges, traders who need consistent income to pay bills, the 1-to-1 approach is almost always superior. The question you need to ask yourself honestly is this: am I that rare trader? Can I genuinely handle the psychological warfare of a 35% win rate system? Have I actually tested this, not in theory but in real market conditions with real money and real emotions? Because here's what I see constantly. Traders convince themselves they can handle it based on a spreadsheet. Then they hit that 7th consecutive loss in real trading, and everything falls apart. They overtrade trying to make back losses. They take revenge trades. They abandon the system right before it would have worked. The beautiful math on paper becomes a disaster in execution. Be brutally honest with yourself. If you find yourself constantly tempted to overtrade, if you catch yourself revenge trading after losses, if you've ever abandoned a strategy during a normal drawdown because you lost confidence, then you don't have the psychology for low win rate systems yet. And that's not a character flaw. That's just being human. Most humans are wired to need frequent positive reinforcement. Fighting against your own wiring is a losing battle. The best risk-reward ratio isn't the one with the highest expected value on paper. It's the one you can actually execute consistently given your psychology, your capital situation, and your life circumstances. A 1-to-1 system that you can trade every day for a year is infinitely better than a 3-to-1 system that you abandon after 3 months because the psychological pain became unbearable. The strategy you can actually execute will always outperform the theoretically superior strategy you can't stick with. So let's bring this full circle. You came into this video believing that 3-to-1 risk-reward ratios were the mark of a professional trader. That risking less to make more was obviously superior. That anything less than 2-to-1 or 3-to-1 was somehow amateur or inefficient. The math made it seem inarguable. But now you understand something that most retail traders never figure out. Trading isn't a math problem. It's a psychology problem that happens to involve math. The real equation isn't risk divided by reward. It's edge multiplied by executability. And executability is where most traders with impressive-sounding risk-reward ratios completely fall apart. You've seen why losing 8 trades in a row isn't an anomaly for a 35% win rate system. It's a statistical certainty that happens multiple times per year. You understand that these losing streaks don't just hurt your feelings, they physically alter your brain chemistry, decreasing activity in your prefrontal cortex while spiking your amygdala. You're literally making decisions with reduced cognitive capacity. You've learned about the winner's effect, how frequent wins create a biochemical feedback loop that makes you a better trader, while frequent losses trap you in a cortisol-elevated state that impairs everything from pattern recognition to risk assessment. You've seen why elite firms like Jane Street use 1-to-1 ratios focused on high-volume consistency rather than hunting for home runs. And you understand why prop firm challenges mathematically favor higher win rate systems, with 1-to-1 approaches passing 67% of the time versus 41% for 3-to-1 systems. The trading education industry sold you a story that sounded sophisticated. The professionals are showing you what actually works when human psychology meets market reality. Higher win rates with tighter risk-reward ratios aren't a compromise. For most traders, in most situations, they're optimal. The trader who survives and thrives isn't the one with the most impressive risk-reward ratio. It's the one who can execute their strategy day after day, month after month, without being psychologically destroyed by normal market variance. It's the one who's still trading a year from now because their system was built for human psychology, not just mathematical theory. Stop chasing what sounds impressive in a comment section. Start building what you can actually trade consistently. Test both approaches with your own data. Be honest about your psychology. Find what works for you, not what works on a spreadsheet. Because at the end of the day, the best trading system isn't the one with the best hypothetical returns. It's the one you'll still be executing when everyone else has quit. That's it for this one. If this changed how you think about risk-reward ratios, let me know in the comments. And if you want to go deeper into building systems you can actually execute, check out the rest of the Trader's Bible channel. Until next time, trade well.